All right, this is the GoldCast. I'm Jim Sharpe along with David Fischer, the CEO and the founder of Landmark Capital. How you doing today, David? You enjoying yourself?
Yeah, it's a little bit warm here this weekend in Phoenix, triple digits.
If you're watching anywhere else, be thankful. Let's talk about how the markets have performed up to this date so far.
So year to date, the markets obviously, not only the weather in Phoenix has been hot, the markets have been hot.
Yeah.
But the Dow is still down 10.3%, which was the same as it was last week. You know, we've had the last couple sell-off days in the Dow. The S&P is down 2.9%, which is a little bit better than last week. These are year-to-date numbers. NASDAQ, though, is up year-to-date 16.7%. And the winner today is the color of my tie. 18.9% gold is up year-to-date.
Wow.
The road to recovery, Jim, is paved still with uncertainty. In fact, you and I were talking about this earlier in an article. The European Union Economy Commissioner said recently that the International Monetary Fund is slashing economic forecasts. They're showing global economy is having negative growth rates this year, worse than what they previously estimated. And they're warning of a crisis like anything the world has ever seen. That's what the IMF is saying. And the Fed has said that it's going to be a long recovery, but that's where the markets are, and that's how things are responding.
Yeah, in fact, I was reading that it looks like Europe is going to contract their economy, maybe even a little bit more than America is, and we're talking 8.5%. That's pretty scary stuff. It really is. So, why in such challenging times are stocks going up? I mean, logically, they're supposed to be going down, aren't they?
Well, it's two words: the Fed.
Yeah.
There's still this disconnect that's happening between Wall Street and Main Street, and yet Wall Street has starting to come into reality since in reference to where Main Street is, because they're starting to have, as you know, in Arizona here, we're having another wave of a COVID-19 breakout.
Oh, yeah.
And it's happening in Texas, Florida, and a few other states. The unemployment is not fully recovered. It's getting a little bit better, but we still have 18 million people unemployed, or 11.1% is the unemployment rate. The Fed and many others are saying it's going to take up to a decade to get to unemployment back to the COVID-19 levels, pre-levels.
Yeah. Geez.
So it's a long recovery is going to happen. But during this recovery, subsidized programs that we had here, you know, aggressively, now are going to start to run out at the end of this month, and could trigger another crisis, since homeowners are going to have to start paying their mortgages now if they weren't making those payments. And you know, student loans are going to have to start to be paid in October, but the government is having to make a choice. And I'm glad I'm not in President Trump's shoes or any other shoes on this choice. They're making a choice between saving lives and saving the economy. And the Fed in the pandemic is creating trillions of dollars to balance the millions of job loss. JP Morgan is saying there is a sea of debt as far as the eye can see. We're drowning in debt. And fleet sales for cars plunged 56% in June. Most say, and I think you would adhere to this is the craziest environment we've ever been through. We're not going to get out of this quickly. In fact, the chairman of Interactive Brokers, Thomas Peterfy, said this week what he sees from a professional side is investors are not really buying aggressively. They're raising cash in this rally. And I'm going to give you 3 new letters to think about.
Okay.
N, P, and B.
All right.
I'll be thinking, what does that mean? No plan B. There is no plan B.
Oh, yeah.
Plan A is the Fed and the government is it's the same. Throw tons of money, enormous amounts of money in the economy, and hopefully this recovery will become a reality. But the reality is, Jim, for every $3 we spend, we only get $1 of economic growth out of it. So that's where we're at.
By the way, I saw a really, really scary stat, and it shows that you don't even have to be an economist or an expert on precious metals to know how bad the economy is. almost a third of Americans were unable to make a full or on-time mortgage or rent payment in July.
Wow.
Isn't that crazy? I mean, that's just so frightening. It really is. You know, you were talking about no plan B. I think a lot of people would have thought this is plan Z and would never happen. But a couple of weeks ago, you predicted that the Fed is going to start buying stocks. Now, do you still think that's going to happen? And when will that happen? And what effect would that have?
Well, yes is the answer. But I want to quote George Washington, our first president.
Mm-hmm.
Unsecured paper money would ruin commerce, oppress the honest, and open the door for every species of fraud and injustice, quote unquote. Central banks buying stocks is unfortunately not a new thing. The Bank of Japan owns 70% of Japan's equity ETFs. They started buying those back in 2010, and another central bank, the Swiss National Bank, currently right now owns $100 billion in U.S. stocks. In fact, I could pull the list. They publicize what list. The number one is Microsoft's, just for those that might want to know, but a lot of tech stocks. But I said that they were going to buy stocks. And 6 months ago, Jim, if you and I were having this conversation, or any economist brought it out there and threw it out there just to see what would stick against the wall, see if the Fed was going to buy bonds.
We would have thought they were cuckoo.
Yeah, it would have been emphatically no.
Yeah, right.
Yeah. But the Fed broke their mandate that was set up in 1913, which only allows the Fed to purchase two things: mortgage-backed securities and treasuries. They broke that by buying bonds, but in addition, they bought bond ETFs recently, just a couple months ago, and they were able to do so by setting up a loophole called SPVs, which is a special purpose vehicle. In other words, an LLC they set up. And they did two of them. I'm not going to get all the technicals. One was for regular bonds. One was for the index of bonds. But this loophole allowed them to do this. And I have an actual copy of the Fed power of attorney, which they signed back in March with BlackRock. And in that, I'm not going to read the whole thing, but here's the section. I'll quote that. It's that they give the power attorney to BlackRock complete authority to purchase, sell, exchange, convert, or otherwise transact in any and all stocks, bonds, cash, held for an investment, or other assets as BlackRock Financial Management, Inc. may select, end quote.
Wow.
So there is no plan B. It is, now let's throw the money at this, and just out of curiosity, on the coattails of this, billionaire gold investor Scott Minerd, which he's a stock guy, pointed it out and said this on CNBC, that the Federal Reserve now has to pull out the bazooka. And he says, I think that is an option, and that option is now part of the plan and is on the table for the Fed to buy stocks. So I think you're going to see it. Unfortunately, it'd probably be good for stocks, but it definitely would be good for gold. And it makes less trust towards the Fed, obviously.
Wow. You know, and it feels like they're going to pull out the bazooka, and it's going to be like, you know, one of those cork pop guns, you know, it's going to be a big piece of cork that comes flying out. Yeah. And now you predicted in January that gold would outperform stocks. I'm imagining you're still hanging on to that position.
Yes. And obviously the numbers so far is the case. So the recovery is slowing now. And the market is also slowing in stocks in this upward trend. Yet the Fed and the government issued and are going to still issue more money. I mean, there now is $1 trillion stimulus package bill that's probably going to get passed. But there never has been in a time where paper index have outperformed gold or silver, Jim, during the environment that we're in, where they ballooned the national debt or the Fed balance sheet has expanded, you know, to help a recovery or, you know, get out of recession, you know. But the government and the Fed are issuing and spending more money in the last 4 months, just 4 months, significantly more than the previous time before of 4 years, from 2008 to 2012, in the aftermath of the downturn of the economy. And during that 4-year period, the Dow went up 78% by index, and gold by index went up 188%, and silver 475% in the index by the same period of time. And we can look at the 70s, the same case. Gold, the Dow went up 9% in the 70s, and gold went up over 500%, and silver did even more. So we're in this environment. You got to get some diversification in gold and silver, because that's what this means. This environment dictates to higher prices in gold and silver, more so than probably stocks historically.
By the way, if you're watching us on YouTube, just search Landmark Capital and subscribe, or of course you can find all this info at landmarkgold.com. That's landmarkgold.com. And please, David, give them the number.
602-287-9200.
All right. That's 287-9200. And you and I will talk soon on the GoldCast again, David.
Sounds good, Jim. Thanks for today.
You bet.